Hey everyone, and welcome. Today we are going to cut right through the noise. Seriously, if you're tired of charts that are just cluttered with dozens of indicators, you're in the right place. We're going to dive into a super powerful strategy that uses just two simple lines to map out your entire trading week. Let's do this. Does your trading chart ever look like a tangled mess of spaghetti? Indicators on top of indicators where you can barely even see the price? You're not alone. It's a huge frustration. But what if the key to clarity wasn't about adding more stuff, but taking it all away? What if the most powerful signals for the entire week were hiding in plain sight, just waiting to be drawn with two simple horizontal lines? Okay, so before we jump into the how-to, we absolutely have to understand the why. This is so important. We're not just drawing random lines on a chart here. We are identifying the literal battlegrounds from the previous week, the exact points where buyers and sellers went to war for control, and one side came out on top. Believe me, these levels tell a story. So what are these magic lines? It's really simple. The previous week's high and low. That's it. It's the absolute peak and the absolute valley of last week's price action. I want you to think of them as the outer boundaries of the market's memory. And as you're about to see, the market has a surprisingly good memory for these specific prices. So why on earth do these levels work so well? Well, it's not magic. It's all about collective psychology. First up, you've got market memory. Thousands, maybe millions of traders are watching these exact same levels, which kind of creates a self-fulfilling prophecy. Second, and this is huge, you've got liquidity pools. This is where the big institutions, the big banks, place enormous clusters of buy and sell orders. It's where they defend their positions or try to trigger a huge breakout. We're basically learning how to spot the footprints of the smart money. All right, theory class is over. Let's get practical and build this into a simple, actionable plan. The real beauty of this strategy is that it's a clean, repeatable process you can use at the start of every single trading week. No guesswork needed. And here it is, your new 3-step weekly ritual. Step 1, you mark your levels. This takes, less than a minute on a Monday morning. Step 2, and honestly, this is the hardest part. You just watch and wait. You let the market come to you, no chasing. And finally, step 3, when the price arrives at your level, you analyze how it's behaving and then you execute your predefined plan. Mark, watch, and plan. That's really it. So what kind of reaction are we actually looking for? Well, there are really only two stories that can unfold at these levels. Over on the left, we've got rejection. This is where the price hits the level like it's a brick wall and starts showing clear signs of reversing. We're talking long wicks on the candles or just a total failure to push through. Then on the right, you have the breakout. This is when price just slices through the level with real conviction, often with a spike in volume, and it starts to treat that old ceiling as a brand new floor. Theory is great and all, but let's see how this actually plays out on a real chart. We're going to walk through two classic scenarios, a picture-perfect rejection trade, and then a failed breakout. It is so important to see both sides of this, because understanding how to manage your risk is just as important as spotting the winners. Okay, let's imagine we're watching the chart for gold. It's been rallying all morning, and it's getting really close to the previous week's high. Now, we're not doing anything yet. We're just watching. Does it show strength and blast right through, or does it start to stall out and show some weakness? We're patiently waiting for the market to show its hand. And boom, here's the plan in action. Price hits the level and prints a strong bearish candle. Maybe it's a big engulfing candle or a pin bar. And that's our confirmation signal. Right then, we enter short. And here's the crucial part. Our stop loss goes just above the high of that candle. We have defined our exact risk before we even get into the trade. With a logical target set, the market reverses and we capture a clean, planned-out profit. All right, now for the other side of the coin, which is honestly just as important. Let's take a look at Bitcoin. Price is rallying hard and it closes firmly above the previous week's high. This looks like a classic breakout, right? A clear signal to go long. So we follow our plan and we enter the trade. But then the market throws a curveball. Instead of continuing higher, the price immediately slams back down below our level. This is a classic fake out. Sometimes it's called a stop hunt, and it's designed to trap eager breakout traders. But because we had a plan, our stop loss was already in place. It gets triggered for a small managed loss. Now listen, this is not a failure. I'm going to say that again. This is not a failure. This is the strategy working perfectly to protect your capital. This is what professional trading looks like. And that brings us to what I think is the most important part of any strategy, the person who's actually clicking the buttons. You can have the best system in the entire world, but I promise you, if your mindset isn't right, you will fail. This weekly high and low strategy is, more than anything, a test of your discipline. And wow, this quote just says it all, doesn't it? The market is practically designed to prey on your emotions, your fear of missing out, your greed, your impatience. Your job as a trader is to have a plan that lets you sidestep those emotions entirely. And this strategy, it is that plan. So what does the right mindset actually look like? Well, it's the patience to literally sit on your hands for hours, maybe even days, just waiting for your setup. It's the discipline to wait for a clear confirmation candle, not just an itchy trigger finger because you have FOMO. It's the flawless execution of your stop loss, treating it like it's your best friend in the market. And above all, it's objectivity. It's trusting the lines on your chart way more than the butterflies in your stomach. Okay, so we've covered the why, we've covered the how, and we've covered the mindset. Let's wrap this all up and condense it into a simple, powerful checklist you can use every single week to stay on track and trade like a pro.
Before you even think about placing a trade, just ask yourself these 5 questions. 1. Have I marked my levels? 2. Do I have a plan ready for both a rejection and a breakout? 3. Is my entry signal crystal clear? 4. Are my stop loss and my target defined before I enter? And 5, and this is the big one, am I emotionally prepared to be wrong and accept a small loss? If you can confidently answer yes to all 5 of those, you are trading from a position of strength, not emotion.
So there you have it. We've seen how just 2 simple lines can bring a massive amount of clarity to your trading. It's a simple, elegant, and really powerful way to frame the market each and every week. Now, I'd love to hear from you. Do you use the weekly high and low levels in your own trading? What has your experience been? Drop a comment below and share your thoughts. Thanks so much for watching.